welcome a phone call and a follow-up after the webinar, but it's just to state our disclaimers out in front at the outset. Perfect. Yeah, so just some introductions. As previously mentioned, there's my face up there. Been at the company for over 5 years now, as you'll see, Claire has as well. Main focus on pensions in the initial stage of my career with Ascot, but now advising on the client side of things. Claire, welcome.
Hi, hopefully lots of you know who I am. If you don't, one of the advisors at Ascot Wealth. I've been there for all of my adult career. So yeah, tax planning is a big focus on the work that I do.
Perfect. Awesome. So yeah, we're gonna get cracking. I'm just to set up at the outset. I'm in the Cape Town office, so if you see a few beads of sweat start sort of perspiring, it's currently I think 28 degrees. So I do apologise. I hear obviously the weather in the UK is a lot worse. So there's worse places to be. But yeah, just to set the webinar agenda. I mean, we're going to discuss this in greater detail, but we just essentially looking at when is the tax year end, what are the benefits of utilising these tax allowances, and what do you have available to use each and every year. And obviously we fast approaching that tax year end. So 5th of April 2022 is the cutoff date. They effectively I've got a countdown clock there for you at 28 business days. So I just put in there, actually you have less time. The reason being is that it depends on the provider that you are dealing with, the fund house or the pension provider or the ISA fund manager that you might have, because that company or provider or platform might cut off deposits for new cash, for instance, actually before the time. So midnight might not necessarily, or midnight right before the deadline, you might not be able to get your money invested in on time. So it's just very important that you actually take a look at which providers and platforms you're currently with, just so that you can make those necessary decisions on time, or get it in time. Just an ancillary note there, we do offer tax return services, so if you do have any questions on the tax return side of things, we'd welcome a call after this webinar. Perfect. So looking at the allowances available to you as an income earner in the UK, that's set at £12,570 as your personal allowance. Frozen until 2026 from the budgets in the last few years. So when we're having this tax year-end webinar this time next year, I'm sure you will see that same figure there. So frozen until 2026, and obviously any income earned up until that amount is received completely tax-free. Perfect. So a very big driver of tax incentivized and efficient investing is your individual savings accounts, your ISA. These allowances are up in front of you. These allowances, actually, if you look worldwide, are very good. The equivalent over in the States is around $6,000 US for an adult, or the equivalent of an adult ISA. If we look here at South Africa, it's a lot less than £20,000, but we'll leave that for another time. But sure, £20,000 for an adult ISA, £9,000 for a junior ISA. You've got your benefits over there. It's in a completely tax-efficient environment, tax-privileged environment, where any growth on your stocks and shares, on your holdings within your ISA is CGT tax-free and income tax-free. Something that they've been championing over the last few years are flexible ISAs. So it's important to know, depending on the provider that you do have your ISA with, it's important that you just differentiate whether it is a flexible ISA or not. That just means that any funds that you withdraw out of your ISA within that tax year, your allowance is not lost within that tax year. So if I contribute £20,000 in this tax year and I withdraw £10,000, it means that I can still replace that £10,000 within the end of this tax year, just so that you don't lose that allowance. So important just to note that, and whether it is a flexible ISA or not.
Sure. And then the only other thing to add on the ISAs is if you've got children that are 16 and 17 years old, they actually benefit from 2 ISA allowances. So they can have an adult ISA allowance, which has to be invested in cash. And they can keep their junior ISA allowance of £9,000 that can be invested in cash or stocks and shares. So yeah, if you've got children or grandchildren that are 16 years and 17 years old, they actually can get 29,000 per annum in those 2 years in this tax efficient space. So that's something that's not, widely known or widely used, but can be very effective if you are, gifting to children and grandchildren in that manner.
Yeah, perfect. And just to wrap this page off, obviously we've just got a wide range of investments available under ISAs. We've got peer-to-peer lending in an innovative finance ISA, which we'll have a separate webinar on, I'm sure. Coupled with your stocks and shares ISAs that you can invest for the long term. Great. I see a question has come through already. We'll deal with those questions at the end, but yeah, I just want to just refer bottom right as the questions come in. If you pop them there, we'll be able to attend to them at the end. So thank you for that. Okay. Claire, over to you.
Cool. So pensions. I'd imagine lots of you on the line have a pension, make use of pension contributions. And we have done 2 webinars on pensions so far. So the power of pensions includes all the benefits of using allowances, the uplift and the grossing up element that you get from the government, even if you're a non-earner. So a non-taxpayer can still contribute £3,600 to a pension, and that would cost you as an individual £2,880, and the grossing up element that HMRC provide brings the pension input amount to £3,600. The cap for earners, so if you earned £50,000, you can put £40,000 of that into your pension. If you're very lucky enough to earn over £240,000, the annual allowance gets tapered down. That tapering goes all the way down to £4,000 now. So it's important to know where your individual limits are. The other sort of tax planning tool that we regularly use, which may not be as widely known, is the carry forward allowance. So the pension that you can contribute in 1 year is the allowance for that year and the 3 previous tax years, should you not have utilised it in that time. So if you capped at your earnings. So if you earned £100,000 and you haven't contributed to an ISA, you could put that full £100,000 that you earn into an ISA. The calculations. Pardon?
I was just saying, sorry, into a pension. You just got your.
Oh, into a pension. Yeah, I keep saying ISA. Into a pension. And yes, you get the tax relief at your marginal rate. So if you are a higher rate taxpayer, you would receive the higher rate relief. So you can see there that, the difference between the pension and the ISA is the pension receives an uplift on the way in. The ISA, you don't get that immediate rebate of taxes or uplift on the contribution amount. Pensions are fixed until 55 years old, soon to be 57 years old. So you cannot access the funds in your pension until your retirement age. which, yes, as I say, for lots of you on here, could be changing in the next couple of years. So yeah, important to know that as well. The pension in the ISA tax wrapper, it gives you the same privileges. So the growth and the income within the investments within the ISA and pension, all are free of taxes. Another important thing on pensions is that they are outside of your estate for inheritance tax. So the value of your pension can pass to beneficiaries without the need for completion of probate. So they can be very valuable assets for your beneficiaries to receive, before probate gets granted, which can take anywhere from 6 months to sort of 3 years. The pension would be accessible, and there is no inheritance tax on the value of that. So the tax year end planning example we've got here is basically to use the carry forward allowance. So to work out, your pension input amounts over the expected up until the end of this tax year. And then your previous 3 years pension input amounts. That's very, very important to get that right, because that would be your full allowance. The next part is your relevant earnings within this tax year. And that also, for those of you on payroll, that would include your end of March salary. So that would be factored in to the relevant earnings for this year. Dividend income is also used in this calculation. It's used in the calculation to work out what your annual allowance is for this year. So should you be tapered or should you not be tapered? If you've got a very high level of dividend income, that can't go into a pension because you haven't earned it, but it would affect your annual allowance. All of those factors come in, and this is the reason we do carry forward and the reason you guys use us as advisors. I've just seen Rob's question. Yes, the limit on pension contributions to receive relief is 75 years old. So all the way up to your 75th birthday, you can contribute to a pension and receive the tax relief, not after you're 75.
Perfect. Yeah, thanks for that. Further allowances available to you all. You've got an annual gifting allowance, £3,000 per each tax year. You can carry forward using that carry forward. If you haven't utilized your previous year's worth of gifting allowance, then you can bring that into this year. So, for instance, if somebody didn't gift last year, you can now make £6,000 worth of gifting in this year. But we obviously we would suggest utilizing this each year. There are further allowances for small gifts and wedding gifts at £250 and £5,000. I mean, the key benefit here is the fact that it's going to be outside of your estate. These are allowances available to you, as if you don't use them, obviously you lose them. So 40% savings on an inheritance tax would be the main benefits. Just got a worked example here for you guys. Just stating, obviously, Mr. and Mrs. Brown would like to discuss IHT planning. They've made no previous gifts, which means that we can look 1 year previous, and to discuss that IHT annual exemption. So how much IHT could be saved immediately by using that exemption. So if both Mr. and Mrs. Brown were to make use of their full gifting allowance, which would be £6,000 each, because they didn't make any previous gifts in the previous tax year, then that means £12,000 would be gifted and fall outside of their estate, and 40% of that is £4,800. So that's £4,800 that you're saving immediately by making that gift, as it is going to be outside of your estate for inheritance tax purposes. So the government won't be able to get a hold of that in that respect. Great. Looking ahead here, further allowances available to you. I'll hand that back over to Claire to... sorry, this is actually one for me. Apologies. It's always fun doing it live. Yeah, available allowances to you. Obviously, the capital gains tax-free allowance is a big one. Again, frozen until 2026 at £12,300. And this is just key that we just subtract any capital gain that has arisen from the past tax year within that £12,300. As with all these allowances, if you don't use it, you lose it, which we'll see here by the a few strategies that we've put in place. It's important that we utilize these exemptions, these allowances, so that we can make that future tax planning a beneficial one for you. Various strategies, interspousal transfers, to gift it to your spouse if he or she has not made use of their allowances or has got the room in their capital gains tax exemptions. BED and ISA, that's whereby we take investments from an unwrapped location, being a general investment account, for instance, and we put that into an ISA, BED and ISA. So we're utilizing, or we are realizing some of those gains in order to park it into a tax efficient vehicle, which is that individual savings account, that ISA. Rebalancing unwrapped investments, so we can look at towards the end of the tax year, realizing some of those gains so that we utilize that £12,300 of your allowance, annual exemption each and every year. Last thing here, if you are going to sort of managing gains or substantial gains over the next few years, make use of your your basic rate band at 10%. As if you go into the next tax band, it's going to be at 20%. So, as I said, a few years worth of planning is involved here, so that we just max out that basic rate band at 10%. When you are over that annual CGT tax exemption at £12,300. Just another reminder, obviously before the 5th of April 2022, if you don't use it, you definitely will lose it. So I'll hand over to Claire for the last section, and then we'll get into your questions.
Sure. So this last section here is a sophisticated planning tool. For some of you here, you will have exhausted, your ISA, you'd have maxed out your pensions, and you would still be looking for some tax planning products and alternatives. So something that we specialize in at Ascot Wealth Management is the unregulated schemes that are, fully endorsed and created by HMRC. So there's not, any sort of funky planning, or it's not frowned upon in any sense of the word at all. There's 3 that we use very regularly. There's the venture capital trusts. These are the largest, most established businesses in the UK. So if you were to invest in a venture capital trust, that you may see abbreviated to VCT, you get the 30% of your income tax. Well, 30% of the investment is rebated against income tax paid. The holding period is 5 years. The enterprise investment scheme is smaller companies, the venture capital trust portfolios. You also get 30% of your initial investment back should you have paid enough income tax to pay that. The minimum hold for an enterprise investment scheme is 3 years, so slightly shorter. And then we have the sort of highest risk, smallest companies. That is the seed enterprise investment scheme, so the SEIS there at the bottom. And with the SEIS, you receive 50% of the investment amount back against your income tax liability. So those are 3 options there that, you would have to speak to your individual advisor about. Some people, they are extremely useful tools. For some people, they don't fit in their risk tolerance because you are investing in, startup unlisted businesses in the UK. But yeah, we've done another webinar on those products and how they work. And yeah, that's going to be available to view. I'm sure it'll be in the follow-up email from this webinar. Yeah.
Perfect. Yeah, thanks, Claire. Yeah, we will follow up. Claire previously mentioned the power of pensions as one of our previous webinars, as well as that tax incentivized investing schemes. So yeah, we are in the Q&A section. So I'll just hand over for more housekeeping to Sean. If he's anything,
you guys can deal with the questions as you go along. I'll just publish them up there for everyone to see.
Okay, perfect. Yeah. AWM ISA is flexible. Just it depends. The platforms that we use, the True Potential platform, those are flexible. And if I'm not mistaken, the Standard Life ones are not. So that's obviously it's important just to note that. We'll go to the next question.
Good question, Bob. Yes, if you invest, let's say, in a direct equity within your ISA, and that is paying a dividend yield, you can either reinvest that dividend into the ISA, or it can be physically paid to your bank account, and there would be no tax due on it because the source of that investment is wrapped up in the ISA wrapper. So it's the same for interest. So if we end up in an interest rate environment where a deposit account can give you 5% interest per year, that interest can be paid to you from your ISA balance or from the interest earned on your ISA, and that wouldn't be taxable either.
Okay, from Don. So yeah, this would be larger tax planning and gifting planning. So we'll definitely need to have a follow-up call. Claire, you want anything to add?
Sure. So larger gifts outside the annual exemptions, which I'm sure lots of you have considered and have spoken to us about. Larger gifts follow the 7-year rule. Whether it's a gift directly to an individual or into a trust structure, there's 2 different ways of managing that. But in any scenario, if you gift over your annual allowance, that follows on the 7-year cycle. So the day you gift it is the start of that. It doesn't run by tax years. It's literally on the calendar day that you've done that. And then 7 years and 1 day on exactly the calendar day again, it would be outside of your estate. Depending on your estate size, you may make use of the taper allowance for IHT gifting. If your estate is over the nil rate band, then the taper doesn't apply to you. So essentially on a larger gift, you think about the 7-year clock rather than tax year planning.
Yes. Yeah, just one from Rob. Just capital losses can be carried forward. They can. So any unused losses from previous tax years can be carried forward. So just wanted to touch on that.
Yeah, so losses, you don't lose the ability to hold your loss position until you've used it. So until you offset that loss with a gain, you still have that amount of gain to use before your annual exemption. So yeah, losses are carried indefinitely until they're used, whereas gains crystallized in a year, that is that year.
And then, just on the CGT into spousal transfers, so that would just mean transferring from spouse to spouse. So in my example a bit earlier, if a husband hasn't used his or has still got room on his CGT annual exemption, then the spouse would be able to transfer assets into his name in order to realize those gains for that year. Yeah.
So if you have an unwrapped investment like a personal portfolio or general investment account in Mrs. name, and Mr. hasn't used any gains in that year, Mrs. can transfer X amount to Mr. and Mr. sells that, and should that gain be less than £12,300, there would be no liability to capital gains taxes. So it's just if you are in a married couple, civil partnership, you can make use of each other's allowances. So essentially, you've got 2 allowances rather than 1 in each year.
Any more questions?
Yes, there is. The CGT is an ISA wrapper. So that question is a strategy that we use. We naturally use it more likely at the beginning of the tax year. And what that does is crystallizes the position on an unwrapped investment and sells that to cash in order to fund the ISA allowance. So in every year, we've got both a general investment account and an ISA wrapper. We would, should the scenarios be correct and you speak to your advisor, they would advise, crystallize gains in the unwrapped investment in order to fund the ISA, which is in a very tax efficient environment. So there'd be no future gains on that contribution and no future taxes, sorry.
And then just a final question from Clive, just in, do you want to publish? Oh, it's already published. Yeah, so when you start taking your pension, that will fall outside of your estate when you sort of meet your untimely demise. So just an interesting point on that is that if you pass before the age of 75, then your beneficiaries will receive that pension inheritance or completely IHT tax-free. Or I should say tax-free, completely tax-free. Post 75, then the beneficiary would be able to receive that at his or her marginal rate. But it would still fall outside of your estate.
And then I don't know which way Clive intended this, but if you draw from your pension, so you're taking income from a pension in drawdown or tax-free cash, or you have a defined benefit, pot that is providing you income, the money you are bringing out of your pension becomes part of your estate. So if you're spending it, if you bring it out and put it in the ISA, that is sometimes advisable, but it would form part of your estate at that point. The remaining balance of a pension in a defined contributory pot is completely outside of your estate for calculation purposes.
Perfect. I don't think there are any further questions. Sean?
Yeah, all right. So thanks so much, everyone, for joining. These webinars are very beneficial to all of us. Just in the meantime, whilst we wrap up, please do take our anonymous survey just to give us some feedback on these webinars. It won't take you more than 3 minutes. If you don't want to do it, then you're more than welcome to skip it. Also, see at the top of your page there a link to our website to book your seat in our following webinar in March based on mortgages. It's going to be on all the hot topics on mortgages. So yeah, thank you so much again for joining, and feel free to leave when you like, and we'll just wait here whilst everyone sort of concludes the survey.
Perfect. Good chatting to all, and yeah, hope you guys have a good rest of your day.